Hello everyone, welcome back to another video. In this video, I want to share 5 unique and fast growing businesses with you. Unique because of the products and services that these companies provide were very interesting and unique to me. And fast growing is because they have been growing their sales and profits over the last at least 2-3 years at a very rapid pace. Now the trouble with fast growing companies is that it's very hard usually to say that this fast growth will continue to happen. Therefore, as a general disclaimer, whatever companies that I share with you in this video, please do not take them as a buy or sell recommendation. Please treat them, if at all, as a starting point for your own research. With that said, let's get started. The first company, PTC Limited, was founded in 1964 by Mr. Satish Chandra Agarwal, and they started off as manufacturers of castings for these very critical components that go into the oil and gas sector. Now, over the last 60 years, they've expanded into other industries as well, such as aerospace, defense, marine, power, etc. Now, over the last 2-3 years, a lot of global and local factors have converged together in a way that they're expected to change the future fortunes of this company. In 2022, when Russia invaded Ukraine, the Western world imposed sanctions on Russian exports. This meant that companies and countries that were reliant on Russian exports were impacted. And one such industry that was impacted was the aerospace and defense industry, because titanium castings, which are one of the largest exports from Russia, is a key raw material in building both civil as well as defense aircrafts. Now, to give you an example, a Boeing 787, around 15% of the airframe is actually built from Russian titanium castings. And companies such as Airbus import around 50% of their titanium requirements from Russia. Companies such as Boeing imports around 30% of their requirements from Russia. So clearly, titanium exports, a key raw material, were impacted in the process. Now, precisely because of how important these materials are for the aerospace and defense industries, I mean both civil aviation and defense aircrafts, this is exactly why this material was not put on the sanctions list. But because of this situation, what it did was it forced these companies to look for alternative ways of sourcing these titanium castings, and that's where PTC Limited comes in, because the company over the last 40-50 years and recently in the last 10 years has developed capabilities, at least the company claims that it has developed capabilities of serving these titanium casting requirements. On the business front, the company earns 80% of its revenues from exports, and recently it signed MOUs and even received orders from companies such as Safran Aviation, Dussault, Israel Aerospace Industries, Bharat Dynamics, and BAE Systems. And as far as the financials are concerned, over the last 3 years, the total income has increased quite nicely. EBITDA margins have increased from around 11-12% to nearly 24-25%, and PAT, profit after tax, has increased by nearly 7 to 8 times. But as far as the stock is concerned, at a PE ratio of 300 times, the company's valuation, the PE based valuations, are far ahead of the fundamentals, and I think it's almost impossible for anybody investing at these levels to make any money. However, as a general disclaimer, as I said, that these companies that I'm sharing, they should be treated as a starting point for your own research and not as buy or sell recommendation. The second business we're talking about is called Gravita India Ltd. It was founded in 1992 in Jaipur, and this is a recycling business, or what we can call a trash to cash business. It has 4 different verticals, and they're all recycling verticals, obviously. One is lead, the other one is aluminium, the third one is plastic, and the fourth one is rubber. But because 92% of the operating profit, or profit before interest and tax, comes from the lead recycling business, that's the one that we'll be focusing on in this video. So currently, as far as the state of the lead recycling business is concerned, it's a highly commoditized, and most of the industry is actually dominated by unorganized players. So currently around 35% of the market is dominated by organized players, and the large chunk by unorganized players. But according to the company, it believes that by the time 2026 comes around, the share of organized will have shifted 35% of the market to around 75% of organized market. So that's the trend that the company is hoping to capitalize on. The way the operations of the company work is that it has more than 1,000 collection centers across India, once these collection centers collect lead batteries from third-party dealers or directly from the consumer, these lead batteries or used lead batteries are then taken to 5 recycling centers that are strategically located such that they're close to the eventual customer. And in India, the company has over 220, 230 plus customers within India. And within India, it recycles around 105,000 metric tons of lead batteries, whereas in total as a company it does 200,000, right? So once these batteries go to these recycling centers, they're obviously the lead is extracted and then kind of shipped to the relevant customers from these 5 strategically located centers. So in short, lead scrap is brought to these recycling centers where it's converted into different forms of recycled lead, such as lead customized alloys, lead bricks, lead sheets, red lead, lead oxide, and then these are shipped off to customers. Right? Now, the interesting part is products such as red lead, which are considered to be higher value added products, right? Their share in the total has actually increased, right? So from 34% in FY 2019, it has gone up to 43% as of today. And the company is hoping that the share of higher value products will increase to 50% by 2026, right? As far as the numbers are concerned, in the last 2 years, there's been a huge jump in revenue where it has doubled from 1400 crores to nearly 2800 crores, and at the same time the profit has more than 4x from 5200 crores to nearly 200 plus crores, right? So numbers are looking good. What worries me, or at least what makes me curious, is that because a significant percentage of the profits, as you can see on the graph, is actually coming from overseas operations, as an analyst, as somebody interested in investing in this business, should kind of look into these overseas operations and make sure that the numbers are solid. As far as the vision for the future is concerned, they have this Vision 2027 plan where they're hoping that 11% growth in volumes will occur year on year until 2027, and that according to the management will come with a 55% growth in profit after tax. Now, I'm not sure how those numbers work out. Maybe the business inherently is at a stage where it can enjoy some economies of scale, where the increase in revenue will result in a disproportionate increase in the profits. The next company, Sula Vineyards, is India's largest and most awarded wine brand. It was founded in 1999 by Mr. Rajiv Sawant, and it exports its wines in over 50 countries. It produces a wide variety of wines: red wine, white wine, sparkling, rosé, etc. And it has 3 different business segments. The first one is production and packaging of its own brands. The second one, production and packaging of other brands. And the third one is wine tourism. Now, as you can see from the graph on your screen, the share in the total revenue of its own brands has actually increased quite sharply over the last couple of years, whereas the production and packaging of other brands has decreased. So the company is strategically focusing on building its own brand. Maybe the brand itself, it believes, has kind of become stronger, and therefore it is focusing more on that. And this along with other measures taken by the company, is actually reflecting in the financials of the company as well, where you can see that the gross profit margin has also improved quite sharply, which is a direct reflection of increasing pricing power. The second one is profitability has increased quite sharply in the last 2 years, and even EBITDA margins have increased, and therefore along with that, profitability has also increased quite sharply. According to the company, it has a market share of more than 60% in the premium wine category, and it sources from over 3,600 hectares, which is significantly larger than the next 2 competitors. It is also a pioneer in the wine tourism business in India, and it runs 2 resorts. One is called The Source and the second is Beyond by Sula. And as we earlier saw, that the contribution of the wine tourism business has gone from 0.3% in 2020 to nearly 8% in 2023. So that's a significant jump, and this is another business that's growing for the company. The next business, NRB Bearings, was founded in 1965 and is headquartered in Mumbai. This is a company that is the largest manufacturer of bearings and frictional solutions, and over 90% of Indian vehicles on Indian roads are running on the company's products. It also has a 60% plus market share in the needle bearing industry. Now, what's fascinating is that the company caters to a wide variety of industries, mostly automotive, but also industrial and aerospace industries. And recently, it has also started manufacturing bearings for EV players such as Ola Electric. I think for me personally, one of the most fascinating aspects about the company's business is the fact that it has 3,000 designs for its products, and it custom builds its products according to requirements of the automotive OEMs, right? So this serves as a huge comparative advantage. This comparative advantage is reflective in its operating margins as well. If you look at the chart, the OPM, the operating profit margins, have been largely stable between 15 and 20% for most of the last 10 years, except obviously the exception being the 2020 year, where sales, profits, margins, everything dipped massively. So but something to bear in mind is, because the company itself, the most of its revenue is coming from automotive OEMs, and automotive sales or auto sales itself is a cyclical industry. The company's business as well is cyclical in that sense. The cyclical nature of the business can be seen from the perspective of the sales numbers, which have kind of fluctuated largely in an upward trend over the last 10 years, but there have been some major fluctuations. And also we can check it out in the net profit numbers as well. And even if we remove the 2020 numbers, I mean, there has been certain element of cyclicality in the business. The fifth and final business, CMS Infosystems, in its present form, was created by Mr. Rajiv Kaul. He was a successful Microsoft executive who left the US in the year 2008, came back to India, and started to look for businesses which where he could turn them around, buy them, invest in them, etc. And he found this company called CMS Computers, which is a part of the IT division of a real estate developer called Subiksha Realty. So somehow he convinced Blackstone Private Equity to buy out the company with him as the CEO. Later, Blackstone sold out to Bearing Private Equity, and many years later, in January 2022, the company came out with an IPO. Today, the company is one of the largest cash management players in the country, with over 70,000 ATMs under management. It has a 46% market share out of the total ATMs that are outsourced to other players. And we'll get to what this means in just a second, but the company covers 97% of the districts in India, which, a distribution network that's much larger than all its other competitors. So cash management simply means that, as you've seen, we have various, we have ATMs all across India in our neighborhoods. And whenever these ATMs run out of cash, somebody needs to put the money back in. And CMS Infosystems is one of the companies that does that job. As far as the revenue breakdown is concerned, 65% of its business comes from its core of cash replenishing business, so cash management, what we just discussed. 30% comes from managed services, which we'll discuss in a second, and 5% comes from technology solutions, which is possibly the most exciting piece. Obviously, it's a very small part of the business, but it has a potential to grow rapidly in the future, and we'll discuss that in just a second. Before we get to discussing these different parts of the business, the most obvious thought that comes to anybody's mind is that cash is obviously on the way out, and therefore the company's business model is probably not so great. And yes and no, because if you look at the actual data, the currency in circulation has actually increased quite a lot since demonetization as well. And while in the long run, it is true that cash might be on its way out, so far the trend shows that cash is definitely going to be around. So 65% of the business, as we discussed, is this cash replenishing business. It's pretty simple. You just keep replacing the cash in various ATMs that are under contract to the company. A company has a massive 46% market share. The second part of the business, 30%, is made up is the managed services business. This is the part where the company actually creates a software and for different ATMs. So whenever you want to activate a debit card or a credit card using the ATM, whenever you want to change your PIN using the ATM, whenever you want to deposit cash in the ATM itself, the software that runs the ATM, that is made or written by CMS Info. Also, the ATM machines themselves in some cases are manufactured by the company. Another minor, it's not a big part, but a small part of this managed services business is whenever you order a debit or credit card, so the printing on those cards that of your name, of the number, of XYZ, that is done by the company as well, but it's a very tiny part of the overall business. The remaining 5% of the business, which is called the technology solutions or the remote monitoring services, this is the part that's most exciting. And what the company is trying to do with the use of technology is it's trying to replace the security guard, right? So on average, according to the company, it takes 45,000 rupees to put a security guard and do the overall security, not just the security, but the overall, the cameras, the XYZ, the entire security for an ATM. What the company is trying, or it is claiming that it is able to reduce that from 45,000 down to 10,000 rupees, right? So that's something that's really unique about the company, and that's what it's trying to do. Secondly, it is also what it's trying to do is it is using AI plus obviously the video technology to manage branches, the security at branches of say NBFCs, right? Because these are also people. So for example, gold finance NBFCs are very high, they have a very high requirement for security services, right? So that's those are the kind of use cases the company is coming up with in this little part of the business of the overall. So currently it only contributes around 5% of the business, but this is rapidly growing. In the last 1 year, it has gone from 0 to 100 crores, and this is expected to be a high EBITDA margin business. So going forward, it'll be interesting to see how things go ahead in this business. As far as the financials are concerned, over the last 1 year, revenue has increased 20%, the EBITDA margins have expanded, and even the adjusted profit has increased by close to 37%. Again, the most exciting part of this business will probably be the remote monitoring services, and as an investor, it'll be interesting to track how that part of the business progresses. Lastly, if you're still here, I have a simple request. If you enjoyed the video, please feel free to subscribe and share it with your friends. I'd also like to let me know in the comment section what you liked about the video. Was there any particular pattern that you saw? Something was similar in all the businesses? Anything interesting that you found? Feel free to share in the comment section. And also, if there's any particular business that you want us to do a deep dive in the future, please let us know in the comment section. And with that, I'll see you in the next video.